So what does this all mean for the markets? We've continued to monitor this at length, and with us again to discuss, we've got Meera Pandit, JP Morgan Asset Management Global Market Strategist, alongside Chris Versace as well here, Tematica Research Investment Chief Investment Officer. So first and foremost, I mean, if we're thinking about the broader implications that this has or has shown up in the markets as a result of the debt ceiling, serious issue, material movements that we've seen in the market that correlate to this, or is the market just saying, yeah, you know what, this will get done at some point?
So far, the market doesn't seem to be reacting. In very short-term paper and very short-term T-bills, you see a little bit more of that. But for the most part, when we look at 2-year yields, 10-year yields, a lot of stability we've seen over the last couple of weeks. And same with the equity markets, don't seem to be pricing in an issue with the debt ceiling. So I'd say we're not seeing a lot of market volatility yet. And I think that is because investors understand that the debt ceiling has been raised or suspended over 100 times since World War II. Regardless of the political party, every single president back since 1959. So I think that investors are confident that a deal will get done. As we get closer and closer to that potential X date, as we get potentially, closer and closer to early June, I think you could see a bit more jitters within the markets. So something to be mindful of. But investors can still position around this. We can still apply risk management to this potential threat. I'd say if we look at 2011 as a comparative point in terms of when we almost breached the debt ceiling and did see a credit downgrade, you saw the traditional safe havens do well. The dollar, gold, treasuries. I'd say with the dollar and gold, what's different this time around is last time we were also amidst a European sovereign debt crisis. Right now, Europe is actually looking better from a growth standpoint, so perhaps less pressure into the U.S. And from a gold standpoint, now we have yield, so the opportunity cost of holding something like gold is higher. Instead, we'd play this through the treasury market, because if there were to be a default, you'd see that in paper that matures around the X date. You wouldn't see that in the broader treasury market. So actually what we saw last time around, yields fell, bonds protected. If we have no volatility related to this, we're still anticipating that yields are going to come down as growth and inflation soften. So ultimately, you can see some benefits either way in the bond market.
What do you think, Chris? How's this going to play out?
Well, I think she's right. I think we've been conditioned to just expect an 11th hour deal, but as always with any deal, the details are really going to matter. And I think that's why when you see certain sectors have traded off, like defense, right? Mm-hmm. Questions, will defense spending be cut, right? We take a look at some of the healthcare sectors as well. What is going to happen, not necessarily in the coming 12 months, but down the road for Medicare, for example. And I think some of these areas will probably hold up better than expected. So we've been actually recommending folks for shares of like Lockheed Martin, Elevance Health, that these pullbacks have actually made for nice entry points. So you really need to understand the moving pieces, but make no mistake, until we know what the deal is, there's going to be some uncertainty.
Yeah, definitely. What's more important right now, the debt ceiling or the Fed?
Sorry to laugh. We were chatting before we came on, and we said, really, if you look over the last year, it's been nonstop. There's been one thing after the other, and I think the concern is, even though the next couple days, right, it's likely to be the debt ceiling, then we're going to revert back to the Fed and whether or not we're going to get rate cuts or not. But complicating all of it is we have a gaggle of Fed heads speaking this week with Powell on Friday.
We've already had a lot of them,
yes,
right?
Yeah. And the message has increasingly been, inflation is persistent. We do not see rate cuts. It would not be prudent to think about rate cuts. And yet the CME FedWatch tool still shows a couple rate cuts. So at some point, the market has to wrap its head around this and focus on what's likely to happen, not what it wants to happen.